Property investors in recent years have not been receiving the best media coverage, seen as exploiter of tax loopholes and greedy landlords. But is property investing the root cause of this? Just a quick fact. If you retire at 65, the current New Zealand super pays a single retiree around $22,000 after tax and a couple on $35,000 per year. Let me ask you a question. If you retired with that kind of money, would you be confident that is enough? What's going on, everybody? It's Blandon here from Mortgage HQ, and in this video I want to help you understand 4 reasons of buying a second property and help you see that it's less of a want but almost a necessity. First one being the government super is probably not going to be enough for majority of the families. So if you're getting $35,000 as a couple, after food and utility, that's pretty much half of this gone. Rates, insurance, vehicle maintenance, and petrol, that's probably another 25% gone. And if you want medical insurance, that's pretty much the rest of your money gone. Let's just say $35,000 as a retiree is not going to be very fun. And the only way out of this is to invest early. So the second reason is that your KiwiSaver is not likely going to be enough either. Realistically, you probably want to aim to double what you will receive from the super, which is around $70,000. And let's just say you're prepared to live to 90 years old, you would need around $500,000 in your KiwiSaver to receive double the super. Now, if you live a bit longer, you probably need a lot more. And I've got to say, because in my current role, I see a lot of KiwiSavers. Every single application, every single person that reviews their position, we can see their KiwiSaver. I can tell you this much, not many will reach $500,000 by the time they retire. And if you want a retirement with options, you really want to aim for at least 7 figures in your investments by 65. Hence, people need to invest in other asset class like shares and properties. But heck, if you're already putting all your money in your KiwiSaver, where are you going to get this extra money to invest in shares or properties? This gives us the third reason to consider properties, because it's the one asset class that you can go to the bank and borrow against it. Although interest rates are at 5% recently, it's sort of doubled in the last 2 years. But if you look at over 30 years, historically, we are still at the lowest interest rates that we have seen in the last 3 decades. And because interest rates are going up, rents are starting to catch up as well. So you will start to see a lot more properties that are neutral cash flow. And if you were to invest in the regions, it would be cash flow positive. But because of the tax deductibility rule, it might be a bit harder, but there are definitely strategies like social housing contracts that's going to allow you to become cash flow positive on these properties. But the important thing is that it is the one asset class that the bank is willing to lend you money against. And the fourth reason that you want to invest in properties is that it's historically a great hedge against inflation. We already know inflation is going to stay for the next few years and has been the highest we've ever seen in the last few decades. And there is no better time to buy properties than now, in my humble opinion, because if you look at the last 4 market crashes in history, the latest one being the Great Recession in 2008, it lasted for 17 months. The dot-com bubble in the 2000s, it lasted for 24 months. The computer trading crash or the Black Friday in the 1980s, that lasted 2 months. And then you have the US dollar coming off the gold standard, and there was an oil crisis with OPEC. In the 1973, that crash lasted for 21 months. So on average, they would last around 12 to 24 months. So what does this have to do with inflation? Well, what's really interesting is although these crashes lasted for 12 to 24 months, the expansion after that or in between lasted an average of 100 months or more. In an expansion, it means there are inflation, things are going up in prices, and the economy is good. So if you're not at least equipping yourself or learning more about investing in properties right now, you could be in a massive disadvantage, because we are pretty much 6 months into our recession and the market price have come down dramatically. If you look at property prices in New Zealand and just the global market in general, we are at a place where we need to start thinking where we can allocate our capital. And I truly think this, if you're not spending more time to look at how you can invest your position properly or better, you would be doing your family a disservice. Now, if you want to find out more about how much you can borrow and how much equity you have accessible in your current situation, definitely talk to us, mhu.co.nz. You'll be able to book a 10-minute call from there. And if you want to learn more about property and finance in general, definitely subscribe to our channel and hit the notification bell for more. Until next time, I'll see you guys again.